What's going on, dividend chasers? It's a Dividend Bloodhound here, back with another investing episode. Today's episode we're talking about a UK stock that I bought this week. Really excited about this one. I did have a small position in it already, but this week I used a dip in the market as a massive buy opportunity to double my position. If you want to find out what that stock is, then do stick around after the intro. And if this video brings you some value, it'd be absolutely fantastic if you could smash that like button and consider subscribing and ticking the notification bell for my channel. See you on the flip side of the intro. Welcome into the video, guys. Some of you may have guessed the stock that I am talking about based on my portfolio in the past, and I am talking about Sage, ticker SGE, and it is a business software provider that offers its services globally in accounting, CRM and cloud services for businesses all over the world. Sage Group is one of the leaders in its sector and is one of the largest UK finance and tech companies, with an excellent history of dividends and increases in its stock price over time. This company is at a bargain price right now. It's down to £5.80 from a high of £6.97, and that is based on its quarterly report that it just announced a 3% dip in its profits, even though over the quarter profits revenue was actually up by 4%. They took a slight dip due to the pandemic and openly came out and said this in their quarterly report. The share price took a 15% drop in the trading after this report was announced and has continued to dwindle around the £5.80 mark since. And in my opinion, based on the history of this company, that is a fantastic opportunity to get in. A small 3% dip in profits when there's a global pandemic going on really isn't something to be that shy of at all with a company that's got such a good history as Sage Group. When you actually delve into the figures and the fundamentals in this report, you can actually find out that Sage Group's outlook for the coming quarter and the coming year is revenue growth of 6 to 7%, and they are sat on a contingency fund in cash of 1.2 billion to mitigate any circumstances arising from the pandemic. The dividend will be maintained going into quarter 4 and early 2021. The ex-dividend date for this one is the 14th of January 2021 and the pay date is the 11th of Feb 2021, and the dividend yield is approximately 2.5%. Depending on what price you buy into, especially at the reduction that it is now, you might smidge closer to 3% on that one. Now let's cover a few fundamentals of Sage Group. So its ticker, as I already mentioned, is SGE. It has a market cap of 6.44 billion, a PE ratio of 19 and revenue of 1.94 billion, and its EPS is 0.29. Dividend yield, as I mentioned, is 2.5%, slightly rising if you buy in at the lower price at the moment, and it had a net income last year of £266 million, a profit margin of 13.5% and a debt to assets ratio reasonably low at 55%. When we look at revenue growth for such a mature company, 3-year revenue growth was 7.4% and 5-year revenue growth was 10.5%, although this is a tech company as well, so you could expect to see double-digit returns there, but that is still good, solid growth. In terms of EPS efficiency, 3-year and 5-year growth was 6% and 11% respectively, and 5-year compound annual growth rate was 5%. which keeps this company ticking along, growing nicely, and as you build your dividends in the company and your position, you stand to gain even more on that. The dividend growth in this company is 21 years consecutively raised straight, which makes it an absolutely fantastic company approaching or beyond dividend aristocrat status in the near future. And it is one to hold in your portfolio for the long term, because it has such a strong revenue stream, its services are current, it's a tech company, and it has a absolutely phenomenal history as well. And at this price, it's certainly well worth looking at and not missing out on. Just to present a small counter argument against Sage Group, because I'm fair and I'm unbiased and I wouldn't want to hold back any clues about the company's future. The company is planning to move to a subscription service for providing what it provides to businesses. And initially customers have bought like in lump sums before, where they've bought the service and they've got the service for good, or they've paid in other ways. So now the company is moving towards a subscription charge, whether it's obviously with a subscription it'll be renewed on a monthly, biannual or annual basis. And there is a little bit of concern among investors about how customers will react to that. However, my take on that would be that most tech companies now are moving towards a subscription service. So if Sage starts doing what all its competitors are doing, its customers aren't really going to have anywhere else to go, because the competitors are doing a subscription service as well. The only time people would leave is if a competitor could offer the same as Sage but for a cheaper price. But because Sage is one of the leaders in its sector, I think it will continue to offer the best service, or one of the best services, for really good value for money. To conclude then, in my opinion, and it is my opinion only, I'm just a guy on YouTube, I'm not a financial advisor of course, but in my opinion this company for me is a buy at anywhere near £6.25 a share or below, and that would give you some room for an upside. And at this current price of £5.80, that gives you a significant 10 or 20% growth rate on top of the dividends that is growing for 20 years as well. If you just get in, buy in at this price, we're back to almost the same price it was right when there was the initial sell-off in the pandemic. So you're buying in, the clock has almost been reset to the pandemic, you're buying in at a great time. And to take only a 3% dip in its profit when there's been such a global catastrophe as this one, I don't think is that bad at all, in my humble opinion. So I'm going to continue building my position. As I said, I doubled my position in this company from 20 shares to nearly 40, and I'm going to hopefully add even more than that before the price recovers to £6.50 plus or so. I really hope you've enjoyed today's video, guys. If you can see your way to smashing that like button, that'd be absolutely fantastic, and consider subscribing to my channel as well. And hopefully I will see you in the next investing episode. Catch you later.